So now that we've talked about rate of return and present value, let's talk about why that's important when making financial decisions, especially about investment. So let's say that you're a doctor and you are looking to start up a new office and you have some expectations. It's going to cost $1,000, or we can say it's $100,000 to start up the office. That's in year 0. And then in year 1, you expect from opening that office, which costs you $1,000, to be $250. In year 2, $300. In year 3, $400. In year 4, $450. So you might look at that and say, all right, well, let's see. I invest $1,000 today, and then I get $250, $300, so $550, $950, $1,350. All right. So by investing $1,000, I'll get $1,350, so I'll be $350 better off. Great. The problem, though, is that it's not as cut and dry as that. Because remember how we talked about how the $1 today isn't worth as much as $1 tomorrow. So that $450 4 years ago isn't worth that today. You cannot buy the same amount with that $450 4 years ago as you can buy with it today. So because you're making this decision today, you want to look at how much it's worth today. And we're assuming a interest rate of 6%. Don't worry where that comes from. But what that is, that's the return you would get for investing your money. And so that means that $1 today, right, is worth 94.3 cents. Sorry, other way. $1 in year 1 is worth $9 or 94.3 cents today. $1 in year 2 is worth $8.90 today, or 89 cents today. Year 3, $1 is worth 84 cents today, and so forth. And so when you factor that in, that $250 in year 1 is worth $235.85 today. The present value of $250 is $235.85. Year 2, the present value of $300 is $267. Year 3, $400 is $335.85, and so forth. And so you want to look at all these years in today's dollars. You want to compare your apples to apples. And when you do that, you find the NPV, which is the net present value, to $195.14, which is the present value of all the gains minus the present value of the cost. Now, this brings up an important term, and that is the internal rate of return, the IRR. So the internal rate of return is when this net present value is 0. It's whatever rate you would need to break even. And as that, as the interest rate goes up, this present value is going to go down. So whenever you put in there to where this ends up being 0, that would be the internal rate of return. Now, keeping on that topic, human capital. Human capital is an increase in your knowledge, something that makes you more productive. And education in general attempts to increase your human capital. And medical education in particular is an investment in yourself. So when you go to school, medical school, you're spending money to where you can increase your human capital, become a better worker, more qualified worker, and you become a doctor. So what are the returns there? The returns are your increased earnings. Now, it's a little bit difficult to measure, especially in the case of medical school, the costs and the benefits, because of the time factor, all those years spent studying, that you're going to have to pay tuition and you're going to lose out on pay. But if we look at medical education as a whole, it tends to be not as risky. So the return on investment that's needing that internal rate of return is much lower for medicine than some other graduate degrees. So remember, the internal rate of return is what you need to collect in order to break even. So with medicine, you only need to collect either a 16 or 18% return on that investment in order to break even. And the reason why that internal rate of return is so low for medicine is because there's really little unemployment with medicine, and the pay tends to be high. And so because of that, there's not a lot of risk with it. Whereas some of the other degrees, there may be unemployment, or the increase you get may not be as substantial as you thought it might be. So it's something to consider in that process of when physicians go to become physicians. Unlike medicine, or unlike other fields, medicine has a very, very low unemployment rate. And so there's really not a lot of risk involved there, hence the low internal rate of return. The other thing we look at when we look at medicine is looking at the assets, what you invest in, how much do you get back off of it, both the education side, the business side. It becomes a little more difficult to measure because there's a lot of unknown, especially with time in there, but it's something that is still considered. The other thing we need to look at here is the idea of uncertainty. So when we did our original example, we showed that in year 1 you're going to get 250, year 3 300, year 1 250, year 2 300, 400, 450. But in reality, those are just guesses. In reality, you don't know how much you're going to get from your investment. So what happens is you can have expectations. You can have a high, middle, and low, or you can have a lot of different degrees of it. So this middle, which is good, is okay. 60%, 1,000, 250, 300, 400, 450. But in reality, things could either be better than expected or worse than expected. And so, you could have the good where you do better, you make more money, or the bad where you make less. And so what you need to do is you need to find you have to figure out the probabilities, expectations based off of this. And so the 60% chance in the middle plus 10%, so 60% chance of 250 plus 10% chance of 300, 30% chance of 100. So the expected current value, or the expected cash flow in those years is 210, 245, 315, 350. And we take the present value. Now it's not as positive in this case. Now it's negative. So this is showing that this investment is not worth it. When we talk about medicine, however, and the low risk that's involved, because of that, you're not going to see these bad expectations, or they're going to be relatively low. And so with medicine, the reason why the internal rate of return is low compared to some of the other ones is because of the fact, when we look at this, right, they don't have the bad ones, and they could have the good ones depending on where medicine is going. And so that's why we have the different ones there. Business school, medical school, so forth, there may not be, there could be bad in there, and there could be some good, but you might not get those guaranteed gains that you would get that you do within medicine.